Welcome back, everyone, to the Risk Intel podcast, powered by SRA, where we share risk intelligence from experts across the banking industry. I'm your host, Ed Vincent, Executive Vice President at SRA. Welcome to today's Risk Intel podcast. With me today from the Risk Management Association is Ed Haski. Ed, thanks very much for joining us.
Great to be here. Thanks, Ed.
Ed, you have had quite a journey in the banking space, right? You began at a $2 billion bank, 30 plus years ago. You rode the wave all the way up to some of the largest of the, biggest of the big, largest of the largest investment banks, as well as commercial banks. And then also more recently, experience kind of came back to your roots before joining the RMA. Well, it seems like a common theme throughout that journey was risk management. There are certainly some analytics along the way and enterprise risk work. So we're excited to explore a bit of that journey with you here today.
Yeah, and part of climbing that ladder was just through M&A activity. You're at a small bank and it gets bought, and you survive that acquisition, and then that creates opportunities. But you move to a larger and larger bank, and then before time passes too quickly, you look over your shoulder and you realize, I'm at the second, third largest bank in the whole country, after starting at a very small bank in middle central Pennsylvania. So yeah, it's been a great ride.
So before we get to the last chapter here at the Risk Management Association, I'd love to unpack that ride a little bit, because I think it's fascinating to maybe dig into the culture risk, the systems, right, the experiences that you had right at one end of that, the spectrum, and then also kind of more recently. I think that most of our listeners and subscribers here are in that community regional banking experience. When you kind of made the decision to kind of come back to your roots, if you will, there, how had the regional and community banking environment changed from a risk perspective prior to versus your last or your initial go in that type of business?
I can only speak from my experiences, and this doesn't mean that this is the way all kind of small community banks operate. But I went to a $2.5 billion bank, and the entire C-suite were people from or with my own background, coming from large banks. And so it was such a comfortable culture to go to, because everybody had that big bank experience and that problem solving experience at big banks. And we all took that and applied it to a community bank level. And that real kind of community bank one-on-one service, KYC, know your customer, wasn't just a regulation. It was a real life part of your job. You knew everybody, and that was a cool thing. But having the people surrounded you with your same big bank experience was it was like the best of both worlds, if you will, having that small bank experience, but being around like-minded individuals.
So you had the mindset was there, but I imagine that the systems hadn't necessarily caught up with that mindset at some of those smaller banks quite yet. So can you talk a little bit about that gap or that difference?
That's the biggest gap that you notice. And when I first came from the big bank and went back to the small bank, I was told, as you're problem solving, you're going to look to the left and look to the right, and there's going to be no one there. And you're going to have to just use your experience, use your judgment, use your, the history in helping, your own challenges to make those decisions and move on. There weren't people resources to help validate those answers. And people resources was probably the biggest that, in a big bank, there's a lot of, decisions by democracy, a lot of more committees, a lot of people around you. Here, it's lean and mean. And so from a people perspective, you kind of just used your experience and moved on. Then from a technology, perspective, at the smaller banks with less capital to invest in that technology, those decisions, that capital outlay for technology, it's a lot harder to implement. It's a larger bank has a lot more capital to just, they got data scientists, and in a smaller bank, that term, it doesn't even exist, let alone the technology that they're building internally. So at a smaller bank, the dollars are watched a lot more closely, and any investment, irrespective of what the value proposition is scrutinized to a much greater level than at larger banks. At least that's my experience.
You then, having had that experience, joined the Risk Management Association. So I'm going to fast forward now a little bit, because one of your areas of responsibility now is you have some products that you look after there at the RMA. And so I imagine that, right, you're involved now on the other side of the table there of someone scrutinizing that investment decision. So when you work with one of the RMA members, how do you help them go through that process? And maybe during as you're taking us through that, talk a little bit about the kind of the products that you're looking after there, and it gives a bit of the context as to where that comes from. But how do you help them go through that scrutiny and survive that decision-making process and that investment decision?
Yeah, empathy is a great almost tool to have in a career. And what I've learned in being at RMA is the people that I'm talking to, and RMA as a nonprofit organization, we're there to make the banking industry stronger through its risk management practices as a whole, but then at the individual bank to make that bank better in having a strong risk management framework, executing on its plans, all of those things. And so I have discovered that almost everybody I speak to at my clients or prospective clients or consulting engagements or roundtables or whatever, I've had those jobs, and they're making the same decisions, or they're hitting the wall, or they're meeting the challenges exactly as I've met them in my career. And so I'm bringing to the table those experiences and saying, I've been in your seat. So I've worn your shoes, I've walked in your shoes, and here is what I've learned, and here are some best practices, and here's how to actually put those best practices into play, because sitting on your hands and just discussing it internally isn't going to get anything done.
Those best practices, I imagine those are things that get embedded in products and tools. It seems like that's a key challenge that community and regional banks are facing right now. Is the regulatory environment we're in, right, where there's an increased level of scrutiny, coming in a situation where perhaps the same tools that existed in, right, Wells Fargo, Morgan Stanley, right, a city, right, where you had worked, right, they're not there. So how do we help the bank scale and manage that regulatory pressure?
Yeah, it's really in having the bank not just listen to the value proposition, but understand how that value proposition is going to then be propagated throughout their organization, and really get down into the weeds of having them understand this is exactly how it's going to affect your capital, that these costs are going to result in these savings, your efficiency ratio is going to do this. You really have to get to that kind of a detail for them to realize that the value proposition, how does that materialize in not only our financial statements, but in our actions on a day-to-day basis. And that then goes back to, since I've been in their shoes, and I've implemented these tools, these operational efficiencies, I've seen how it can work. and I'm bringing maybe some lesser publicized experience of not implementing it and realizing in hindsight, boy, I wish I would have had that. I wish I should have done this. And now that I'm here almost on a consulting basis, I'm using those maybe, misgivings as a way to say, this is the reason why you should do this. And this is what's going to make you better.
Let's pick up on that experience and the fact that, right, regulators are now coming in with just an increased level of scrutiny, right? Whether it's on the heels of bank challenges in early 2023, or the growth within the fintech space that is now triggered additional regulation. How do you counsel your RMA members to think about risk and think about embracing technology and tools and measuring risk within an organization?
I think of it in two ways. First is, and I mentioned this before, it's the efficiency. So, the tools that are in existence today. So for instance, at RMA, the primary tool that's under my umbrella is a risk rating methodology. And I had developed risk rating methodologies at previous banks. And so it's kind of a natural fit for my experience and skill set. What is the efficiency of using these tools? Well, risk rating is so foundational to commercial lending. It's kind of where you start. Well, on a spectrum of 1 to 15, or, letters A through, Z, what is the risk of this deal? Is it good? Is it kind of down the middle of the fairway? Does it have some hair on it? Is this out of our, quote unquote risk box? But how do you measure that? And so the risk rating tool is foundational to that. And having RMA have this tool that's scalable to any organization, it calculates the risk rating and gives them a perspective of risk in a deal in a matter of seconds. And so there's no, paper, there's no data entry, there's no, people, 5 people around a water cooler kicking around ideas about what are we, what is this? And did we consider all of that sort of taken into consideration? And, we provide them with that tool. So efficiency is definitely, number one on the list.
So you shrink the decision-making window, you get there more quickly, you get to a more robust answer, and you do it in a cost-effective way.
And that's the other thing, is cost effectiveness. And so, with technology, it's like, I can remember back in the days, the first digital cameras, little pocket cameras, and you had a 1 gig memory card, and that cost $100, and now you can get a terabyte, which is 1 million of those for
right.
$20 or something like that. So the cost of technology has really, really come down. And let's take that and push it to in the banking industry. Technology it's affordable. And so back to my comment about small banks and watching the dollars a little bit more, there are really affordable tools that can meet the needs of the smaller banks. And and I know with our partnership with SRA, that's a big focus for us. The larger banks have the capital, they have access to the tools. They're, while they have a need, they can also build it internally. But in the smaller organizations who look more to maybe the vendors of supplying that because they can't build it internally, we're at a point where this cost effectiveness is there. They don't have to spend hundreds and hundreds of $1,000s to have a consultant come in and have them implement something. These are literally off the shelf, very intuitive from a user perspective, and if I at my age can learn how to use something without a, a user manual, and my saying is, well, if you buy stuff on Amazon, then you got the knowledge to use my tool. It's just, things are in a little bit different places and a couple different clicks, but it's really that intuitive.
All right, and the other element there, it seems like by putting a tool set in place there, it also gets you farther down the road of having a common risk framework, a common operating mechanism within the organization, right? Because it seems like that's the other element here is having something that you can communicate out to regulators, that you can communicate up to the risk committee of the board, right? Getting a framework in place for evaluating deals or opportunities, as you talked about there with the risk rating, or risk programs as a whole, is having that common risk framework and a methodology for evaluating it.
Yeah, when I was head of ERM at a $2 billion bank, we used a vendor supplied module or model. And my hindsight on that is that it was incredibly overbuilt. It was trying to be the best of everything to everybody, and it didn't commonize things enough. And if I always looked at ERM as this triangle where the risk tolerance is set at the top by the board, and then as you move down those slopes, it gets bigger and a little bit more detailed. But at the bottom, our tool was so detailed that by even each commercial lending department had 2,000 to 3,000 different tasks and risk descriptions in their group, that if there was some out of tolerance or some need to take action on that, overused phrase of drinking water out of a fire hose, you couldn't discern the difference between the risks because it was in such detail. And that's why one of the reasons why RMA chose to partner with SRA is we took this approach to another overused phrase, keep it simple, stupid, the KISS principle. Let's just build something that is intuitive, easy to use, commonizes risk across every single discipline, but it doesn't overbuild or overcomplicate what you're going to tell the board or how you're going to take action on it. And that to me is the best of both worlds. It really is.
Ed, we've covered a lot of ground here today. Thank you for taking us on the journey back through the through the history there. I think a lot of handful of takeaways I jotted down here about the importance of people and using that experience, drawing upon the fact that technology is affordable today, and helping people through that process of scrutinizing budgets and picking the right technology, bringing best practices into those discussions. And then lastly, really these themes of efficiency and common frameworks, right? I think that these tie into the themes that the RMA is really bringing into the industry and into all your members.
Yep. Great.
Thanks for being here. We appreciate it.
Thanks, Ed.